This is Alan Bush with ADMIS with the daily financial forecast for Tuesday, December 22nd. In the stock index futures, we did see some strength in the overnight trade. This due to ongoing ideas that the People's Bank of China will be adding more stimulus to their economy, and in general, we are seeing stimulus elsewhere in the world, including from the European Central Bank. Also, we did have some strength linked to the GDP here in the U.S. coming in a little bit better than expected, up 2%. That compares to the estimate of up 1.9%. However, some pressure developing a bit later with a housing number showing a larger than expected decline. However, we do feel that even though futures are a little bit lower now, I think we can see a move back to higher on today. Also still looking for higher prices, in fact, substantially higher prices into next year. Now, moving over to the currencies, the dollar index now on track for its weakest performance on a monthly basis since April. Now that it appears that the Fed will be raising rates several times next year, that appears to be fully priced into the currency exchange markets at this point. Also, we are seeing the euro currency advancing after Spain's economy coming in a bit better than expected, but the pound lower after budget numbers in the UK, although showing an improvement, they did not improve as much as some analysts had anticipated. And we are seeing some gains in the Canadian dollar and the Australian dollar as the crude oil market is a little bit better and appears to be stabilizing at these lower levels. Now, moving over to the interest rate futures markets, first of all, there is a 54% chance that the Fed will be raising rates at the March meeting, March of next year. However, we do feel that the long end of the curve, the 30-year bonds, will probably come under some downside pressure. This on ideas that core inflation rates around the world are starting to move higher. And I think that will be a very significant headwind for the long end of the curve. Also, we did have the 156 and a half resistance area in the March bonds holding very well, and we are lower than that right now. So longer term, it does look like the long end of the curve, the 30-year bonds, will probably come under pressure next year, and I think this is likely to be a trend that will last for quite some time. So once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland, and good trading, everyone.